Chapter 2, folks. Chapter 2 is on analyzing and recording transactions. We are continuing on from Chapter 1, and you'll notice that in Chapter 2, journalizing our transactions is going to take center stage. Now, the way that we are going to do this is by looking at the accounting equation and deciding what's happening to each one of these accounts. We looked at this in Chapter 1 and saw that in that table format, we went through and wrote what happened in each one of our transactions across a row. This time we're going to use more information, and we're going to start using actual accounting documents to provide us with our information. Okay, so one of the first things that I need everybody to do is to learn the accounting equation and debits and credits. Now, if you read through the discussion post on Chapter 2, you'll have seen that, and also in Chapter 1 discussion as well, is that on a T account, which is just a T, okay, here is blank sheet of paper, and there is my T, as best I can draw with my mouse. Okay, a T account is very helpful in helping us decide what's happening to our transactions. So hopefully everybody remembers your accounting equation is assets equals liability plus equity. Okay. So for all of our assets for right now, the debit side, which is the left-hand side, is going to be the side that is going to increase every single one of our assets for now. So if you'll notice in your book, that's why they have the plus sign on the left side of the T account. So for every asset that we're going to look at, right now, debits will increase it. Okay, for every single asset that we're going to look at, for right now, every single credit, which means the right-hand side of the T account, will decrease an asset. Okay, and then because we have our accounting equation, the opposite's going to happen on the other side of the equal sign. So that means that the debit side is going to decrease and the credit side is going to increase. Same thing with equity. The debit side, the left side, is going to decrease equity accounts, and the credit side, the right side, is going to increase. Okay. Now this is where it gets a little tricky. We're going to break out equity into the capital account, which is what we're going to deal with a lot. You saw the capital account in Chapter 1. This is where we're going to record all investments that the owner makes in the business. Okay. So anything that the capital account is going to do is going to increase equity. So for the capital account, increases are going to happen on the same side that it increases on the equity, which would be the credit side. Decreases to the capital will happen on the debit side, on the left-hand side. Okay. Revenues. What we're in business to earn are our revenues. Okay. If you look into Chapter 2 at the end of the chapter with that demonstrative problem that I made videos on back in Chapter 1 with Jasmine Worthy and her hair cutting business, she was making revenue by earning money from haircuts. Revenues are going to increase our equity, so they are going to all, however many equity accounts we have, are going to increase on the credit side, which means then that the debit side revenues will decrease. We're not going to see this side happen right now. We will later on. Right now we're just going to focus in on making sure that we keep adding to our revenue every time we earn revenue. Okay. Now, two other types of accounts under equity are our expenses. As a business, we have a lot of expenses. Expenses are going to decrease our equity. Okay, so this is going to be a little different, but because we're going to decrease with a debit on our equities, that means our expenses are going to have to increase on the debit side. So after a while, once we get into chapter 4, we'll see how the total of all of our debits and our expenses is going to eventually decrease our equity. So if debits increase our expenses, that means credits decrease our expenses. Okay. Then the last breakout of our equity is under withdrawals, and I'm going to abbreviate that as W/D. Okay. This is where the owner is going to take assets out of the business. Okay. This is going to make our equity go down. So that means that we're going to have to continuously add to our withdrawals account by adding on the debit side, because as we find in chapter 4, we will then funnel this into equity, and then we'll be adding it to the debit side, which is going to make equity go down. Okay? So if the plus side increases withdrawals on the debit side, that means the minus side, the right side, will make our withdrawals go down lower. And again, just like revenue and also like expenses, you won't see these happen until chapter 4. Okay? So if you look at this, we have CREW, C-R-E-W, if you kind of get rid of that guy right there. Okay, capital and revenues increase, so they're both going to increase on the credit side because they're going to increase overall equity. We're going to have expense and withdrawals, the E and W out of CREW. Both of these are going to increase on the debit side, and then those are going to go up in here, and once we put this in the debit side, it's going to decrease our equity. So here's how it looks broken out with your accounting equation and normal balances. One thing to note, notice that debit did not change. It was always on the left-hand side. Debit, 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 debit. And credit was on the left-hand side, or right-hand side. Right, 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 right. Okay. What changed was what side increased and what one side decreased. Okay, so hopefully that'll help you. Commit this to memory, folks. This is important. Everything else that you're going to do for the remaining chapters, there's this chapter plus 10 more after chapter 2, that is all going to be based on this information. So please commit it to memory.